Good morning and welcome to the Saxo Bank Morning Call. It is Friday, March 1st, and we need to talk about the Asian session overnight. Lots going on. The Japanese yen a lot weaker, and importantly, Chinese equities, another strong session. We have a chart here, this Chinese CSI 300, whether it's driven by the Caixin manufacturing PMI that came in stronger than expected, still slightly below 50, but stronger than expected. More importantly, possibly, is that small subtitle you're seeing there. Making it official, this is something that's been in the rumor mill for some time, at least for a week or so that I've seen it. This huge bump in the MSCI allocation from 5% potentially to 20% in their indices. Steen, how big a story is this in terms of there's talk of maybe $150 billion or so, plus or minus of flow, but how big a story is this for the Chinese equity market?
I think it's a big story in the sense that it fits the narrative and the construction that the Chinese Communist Party wants to tell the internal domestic audience. And that is that from here onwards, we will have a very strong A-share market in China, because basically what the Chinese government is trying to achieve here is to take some of the bubble condition out of the housing market and transfer some of that net savings into the equity market. Don't forget, in a semi-closed capital account, there's a limited amount of things that the domestic Chinese can invest into, one being gold, one being state bank deposit, one being the equity market, and one being the housing market. Since 2015, there was a drive to go towards the housing market. That collateral value is somewhat more nervous now. It's falling slightly in terms of the pricing. Hence, the government wants to force people into the equity market. So to some extent, we have a fully supported market, which is then, of course, accelerated through the external investors coming in and supporting through increase in indexes like the MSCI, but also the FTSE index and the bond index.
Okay, so yeah, we're up 25% on that major index, and there's plenty of room to the upside looking at where the highs were back in late 2017, early 2018, around 4,400. So also overnight, we're seeing a weaker yen, and through some pretty interesting levels. The 200-day moving average was in around 111.30 or 40, and that was broken overnight. I think the main driver here is strong U.S. data driving treasuries lower, and we're seeing this equity market continuing to grind higher. So the double whammy for the yen, always strong risk appetite and higher yields. See the chart here, you can see that We've gone through that 200-day moving average, the blue line coming in, and the next area up into 112.50. And then I've got a chart of the U.S. Treasuries coming down, finally getting a couple days put together here where we're seeing yields coming higher. And then actually that small low, it doesn't look so prominent on the chart, but it's pretty big if you look at a yield chart that was in January around the 2.80 yield figure. So at least some room down towards there. And for breaking above there, I think it's starting to get really uncomfortable for this market. Steen, don't you think that this is the sort of the pain trade that we've been a little bit too eager to turn around on the Fed, and now we're seeing, strong U.S. data, strong GDP, et cetera?
Stronger dollar, a Fed going from being expected to cut rates to being on pause, I think is the pain trade, because the strong dollar will be the fifth element on top of the four horsemen we talked about extensively last year. And a stronger dollar, let's assume that the euro breaks down and hits 105, 106. What we would then have is a very, very high probability of a global recession.
Yeah, then we have the risk of the irony being the strong U.S. Ends up putting the rest of the world under pressure. Ola, on gold, we're seeing a lot of the same factors that we just talked about actually feeding a lower gold price.
Yeah, we can see some of these, the drivers that we had, especially in December and early January, now fading. We got the stock market still going up. We got the yen weakness, as you mentioned, and we got the bond yields also picking up. That's taking some of the sting out of the bullishness in gold. But we can see the chart here that we're approaching the support here down towards the 1300 level. Another reason I think is, there's several other reasons, but another one is that we have seen the market on several occasions have failed to break above this 1350 to 80 area. So once again, this has attracted some selling. So 1300 level, first area of support. I think the big one is really 1275. But I think also in this context we should mention platinum. And I think on the next chart we can see that platinum has really started to move higher this past couple of weeks. The spread or the discount to gold has collapsed by $100 during the past 2 weeks alone. Platinum is is obviously being driven by the surge we're seeing in palladium, but also, and it's raising some concern or some speculation that there might be some substitution start to come in. But platinum came from a historically cheap level to gold, so that's also attracting some attention.
All right, and also attracting attention overnight is further ugly data and ugly sentiment out in Australia on the housing market. Talk of Melbourne, I think it was Melbourne and Sydney housing prices being back to 2016 levels. There's just it seems to be a gathering momentum there. We've seen Aussie kind of been locked into a range. I think a lot of that driven by the sentiment on the Chinese renminbi, and as well the sense that they're managing their currency stronger. Australia's linked to China, and then all these iron ore, copper, other prices of commodities doing well, and the big mining companies. But the housing trajectory is so negative that we're actually finally seeing it taking control a bit in these Aussie crosses. I have a chart here of Aussie dollar. We see it turning back around to the downside. I think there's very strong risk of a move through 70. Interestingly, in a couple of the crosses, Aussie CAD, Euro Aussie, we're starting to see the Aussie faltering. We've got an RBA next week. They've really tried to continue to put a positive face on things. I think that really needs to have some more caution, given that policy acts with a 9 to 12 month lag. And surprisingly, the market only pricing slightly more than 50-50 odds of a single rate cut by the end of this year. I think that is a drastic mispricing. Would you agree with me on that, the risks for Australia in terms of policy moves? Dealing more with the domestic focus rather than the traditional focus for Australia, which is on risk appetite, commodities, etc.
I think what the RBA and to some extent the global audience is mispricing in Australia is the domestic-driven slowdown in growth creation through, of course, the Royal Commission that's set that will sort of self-inflict on the CEOs and the credit officers of the Australian banking
Credit
system.
impulse, basically.
So the credit impulse is contracting far more than the actual number is being reported. If you traditionally look at money flow like M1, M3. So I think absolutely you're right. Coming into the end of the year, RBA will move to an aggressive stance, and also take it in the context of the global central bank. So if you put it in a sort of a 10,000 feet, every single central bank except for the RBA has sort of caved in and become more dovish. I think it's only a matter of time before RBA follow through. Okay,
so it'll be interesting with that meeting next Tuesday. But as we mentioned on the commodity front, there still seems to be a lot of positive sentiment, whether it's iron ore and other industrial metals.
Yeah. Well, we sent out a note in, we got the next chart there, which is copper. We sent out a note yesterday to fade the rally. We're seeing some resistance starting to emerge here up towards the $3 mark, based on the assumption that the most of the positive news from the trade war or trade talk discussion has been priced into the market. But obviously, with this renewed risk on we're seeing overnight, that idea may get challenged here. But we're basically fading and looking to get back in if we break above 302.
Strong dollar could be an element there as well.
Strong dollar, yes, absolutely.
And what about crude? We're sort of back a bit higher. We saw a big supply report out this week in the U.S.
Crude oil, yeah, I'm struggling to get too excited here. If you look at the chart, we can see we are in a wedge right now. We continue to stay high here, but this is Brent crude. But what I just noticed this morning was after we broke high on the 15th of February, that's when we broke above 65. Since then, the open interest in the futures market has continuously been falling every day. That does not tell me about strength. That's not telling me about new buyers coming into the market. That's telling me something about profit taking. So still at this stage, 68.30. That retracement line there, I think, is quite a big line in the sand. Also, that ties in with that uptrend there on the wedge.
Great. Now, Steen, you brought with you some thoughts on inflation. Where are we policy-wise? We've got this incredible, almost a whiplash-inducing turnaround. We had the meltdown in December. We've had this incredible recovery. We're talking about the pain trade maybe being a bit higher in U.S. yields here. How soon are we going to see the Fed sort of adding on to that rather than just simply easing off to deflate the risk or to mitigate the risk of a huge meltdown in markets?
So as you know, our Q1 was a global policy panic reaction. That is exactly what we got. And now we are getting a classic market reaction, which is they are extending beyond what is actually supported by data. And if you show the chart that I brought along, I think a lot of people have been trying to figure out why and how did the Federal Reserve justify the 180-degree turn they did from the December meeting into the January. Everything is on pause, even talking about the QT ending. As you can see here, what happened really was at the end of last year, inflation expectation collapsed. But what is now also happening is that inflation expectation is now heading back to that line that is 2%.
So the brown line being it's close back to 2% now, the break-even rate.
And don't forget, right now I'm reading Volker's book. Everything about Fed is about inflation targeting. So whether you believe in it or not, that is actually how central banks operate. So the 2% is, the holy grail for the government. If you come in a direction that is too far from the 2% on the downside, you get nervous, you pause. So I think if we could only use one proxy for estimating Fed's reaction to the markets, it will be the inflation expectation. And the inflation expectations right now, as I'm pointing out here, is actually rising into a context of a higher stock market price valuation, which is the political metrics that everybody uses. I mean, no one uses inequality, GDP growth, or productivity. Everybody uses stock market. So combining the political, the momentum, and most importantly, I think in data-based, the inflation expectation rising, I think we have a risk that, and it sets up a great trade in my opinion. You have the US market now coming and most of the US assets, sort of turning the corner. They will be flattish. They will keep some of the momentum that we see in Q1, but at the same time you have a government-supported induced growth sector going on in Asia, led by China, but certainly that will reflect into it. So I think there's a huge trade to be done in equity to be, neutral, short US and long A shares in China.
All right, and speaking of inflation, we do have the Fed's favorite inflation measure out today. Let's have a look at the calendar. There's really too much to cover here in terms of next week, but for today specifically, it's all about manufacturing PMI day. The Eurozone revision, or the final versions, are almost never changed much, but we do have the UK manufacturing PMI up later, and then importantly the ISM manufacturing after a very strong Chicago PMI. It looks like it was only the Philadelphia Fed of the regional surveys that was particularly weak this month, so I wouldn't expect pronounced weakness, at least there. And then as we pointed out, next week that RBA is rather critical given where we are in the trajectory of the housing market in Australia. A little bit less pressure on the Bank of Canada to make waves. ECB, rather important on Thursday. Steen, do you have any thoughts there? Any big signals you're expecting from the ECB next week?
So TLTRO, which is the very tailor-made funding for the banking sector, is extremely critical. But I think next week you will be coming out with a note about the incoming chances of seeing the change of the presidency at the ECB. Political talk right now is that Germany is going to go for the ECB top job, and that will fundamentally change the EU. So I think as important it was to have next week's Thursday on the TLTRO, I think most significant for the balance of the year will be this lead into the who gets the top job at the ECB.
And in my book, the TLTRO is a weak beer in terms of policy impact.
It is very close to water, as they say in America.
Okay. And then, of course, next Friday we have those non-farm payrolls and the jobs report, average hourly earnings. And do look out. I think that March 20 FOMC meetings, all the expectations around quantitative tightening and whether we're going to get a schedule after Powell sort of tipped us off that the Fed will be out soon with some sort of adjustment or some sort of announcement on what it plans to do with the quantitative tightening policy. That'll do it for this week. We'll be back next week with the Saxo Bank Morning Call. Thanks for joining.